Alrighty, next stock I bought here is the giant Amazon, AMZN on this one. Bought 11 shares of Amazon, filled it at 185. Now, in regards to Amazon, this puts me at 1,111 shares. And I might not be able to buy any more Amazon shares because that just seems like lucky numbers there, right? That just seems like I probably shouldn't buy anymore, and I should just keep it at that exact number because it's just like, it's too perfect, man, and just hold those long term. So in regards to Amazon, so far we're up $81,000 on the stock, up 65%, and I think this is really just a start. I think we got a lot bigger gains coming for Amazon here. And in regards to Amazon, it's the 5th biggest position in the public count. The only positions that are beating that is Meta, which is 973,000, 772,000 of that's gains. Tesla's $323,000, $292,000 of that's gains. PayPal's a $240,000 position, $46,000 of that are gains. Palantir is hilarious. $208,000 in Palantir. $159,000 of that is gains now at this point in time, so Palantir is just a crack up. And then comes Amazon, $205,000 position, $81,000 of that is gains, right? So it's a big dog position. It would be the 4th biggest position if it wasn't for freaking Palantir being such a beast, right? It would be. But Palantir, we're up 324% on now, so it's just insane. Alrighty, let me share my base case with Amazon with you here. Here's the deal, okay? And here's why I love Amazon stock, even at these prices. Is it as attractive as when I was buying it a year or two ago? No, but it's still very attractive. Here's the deal. If I run a base case on Amazon of only 10% revenue growth, not a good number for Amazon, not a good number. 15% net income growth, which they should get because they're really running that business lean over the coming years. So I think 15% net income growth is very, I think it's easy. I'll be honest with you guys. I think it's easy for Amazon to hit 15% net income growth 2025 to 2028 on average per year. Easy. Net income margins of 9% come 2028. 35 to 45 P, very fair for Amazon. Actually, very cheap for Amazon. And that gives me a compounding annual growth rate on the low end to 12%, on the high end 19%. That's a super sleepy base case. Like, could it get much sleepier than that base case I just gave you there? No, I don't think it could. 10%, 15% for Amazon, that's nothing. 35, 45p, nothing for Amazon. And even in that super sleepy base case, it's still a big money maker. And this is why I continue to say, if you need a stock to build your portfolio around, right? That core position, that steak, that chicken, that shrimp, okay? If you need a core position for your portfolio, Amazon sets up, as, in my opinion, as the second best stock in the market to build a portfolio around. The best is Meta. Meta's still the best, but Amazon, in my personal opinion, is really that number 2 company that if you're looking to build a portfolio around something, Amazon's that company. You start with Amazon, and then you build your side dishes all around that. And you got your dessert there, and you got your drink, and all these other things. But the core, the steak, that is Amazon. And so, yeah, man, even in that super sleepy base case, it is still such an attractive opportunity. Hey, it's Jeremy. I hope you really enjoyed that clip here today. Would you like the ability to understand how to do your own research and not just rely on others to tell you which stock to buy? Would you like to have confidence in yourself when it comes to making your own investment decisions out there? If you're going to be able to do that, you got to have full understanding of everything you need to look for in stocks, how you can decipher whether a stock is a buy, not a buy, all those sorts of things. That's where my private group comes in to help. The description area down there will have a link to apply to join my private group. We've taken over 1,000 people over time and been able to teach those folks exactly what to look for in companies, how to research companies, how to understand financial statements, understand all the different metrics so you can make judgments on companies. And we've been able to have so many people, an incredible amount of people, hit 6 figures plus in their portfolios, 7 figures plus, even some hitting 8 figures plus in their portfolios over time. So if you're looking to take your game up to the next level and play this on a much higher level, apply for my private group. Once again, the link is in the description area. Now, let me run through this scenario because I think it's very important. The people calling Palantir stock's going to crash, epic crash, down to $20 a share again, which is where the stock started this year. Well, it's actually below 20, right? Stock started this year kind of $16, $17 range, right? And people are thinking that's the sort of crash that's going to happen. It's going to go right back down to that $20, below $20, right? And let's discuss that because I think it's worth discussing. Like what would it take for Palantir stock to have an epic crash like that, right? So Listen, here's the deal. Okay, Palantir trades at a very high forward P. Now we'll speak about if that is very high. It's high based upon where the market usually trades at, right? So let's say you were to cut the valuation in half, put it down to $20, down to a 50 forward PE, then you're talking about you're around 2x to 3x the market, because the market usually trades at a forward PE kind of 18 to 26 range there, right? But the important thing to remember is think about Palantir's growth. The current year expected earnings per share growth is expected to be around 20x the average stock in the market. So even though the stock trades about 5x the average stock in the market, the earnings per share growth is around 20x the average stock, right? And so if you were to cut the stock in half, go down to, let's call it, not $50 a share, around $20 a share, right? And put a forward P of 50 on the stock, you're around 2x to 3x the market, but you're growing like 10x faster than that, right? Because you're growing like 20x in average stock when it comes to earnings per share. Now, if we look at next year's earnings per share growth, analysts are around a 50%-ish number. Well, that's around 4x, 5x the average stock in the market. So if you were to say a 50 forward P makes sense for the stock, based upon what? The earnings per share growth is so much more massive. And keep in mind, Palantir is also a holy grail business model. Because the business model is so sticky, extremely important to understand this. Palantir is always going to trade, even if the growth rates were roughly in line with an average stock, Palantir would still trade far richer than an average company because these sorts of business models are seen as the holy grail. They're the stickiest of the sticky business models. People want to own these sorts of stocks because they just get these big contracts that last many years. And then once they get these customers, these companies used to using their product, those companies are likely going to continue to use it. Government's going to continue to use it, right? So that's a little food for thought in regards to that. If we look at the trailing 12-month revenue growth, right? Keep in mind, the latest quarter, the company did 27% revenue growth, right? 27%. That's around 5x the market, right? If you were to say a forward P that you wanted it to be cut in half down to 50, how does that make sense? Doesn't make sense, right? Since the company's growing revenue around 5x the market, it should trade around 5x a forward PE over the market, right? And never mind if you're talking about next year earnings per share growth around 5x as well, it should trade about 5 times more expensive than the market in general. But it may be even more expensive than that since, once again, it's a holy grail business model. And keep in mind, the margins in regards to Palantir are off the charts, which is another reason why the stock commands a much bigger premium valuation over peers. So if you're hoping for this 50% type crash in Palantir stock, where the stock goes all the way down to $20 or below, it just doesn't make sense. Unless Palantir's business model just get devastated and it just stop growing, right? Sure, if Palantir's business model just stops growing, then yeah. Is that realistic? No, that's I would call that less than a 2% probability that Palantir's business model just stops growing, right? So this whole fascination with the epic crashes coming in regards to Palantir, it doesn't hold weight. It doesn't make sense. That's the bottom line. And you know what they say? If it don't make dollars, it don't make sense. It doesn't make sense for the stock to have some sort of epic crash, right? Now, you got to understand, in regards to this kind of crash crowd in regards to Palantir, a lot of people have made a lot of money in regards to Palantir, right? I'm one of just many people that have made a lot of money in regards to stock, up 352% on this. Believe it or not, and it's hard for me to wrap my head around this, but there's some people, this makes them mad, literally mad. They rage about this. They hate it. They're it frustrates them so bad. We call those people haters, by the way. But and I saw it in regards to Tesla stock, right? Tesla stock made its epic move, and a lot of people made life-changing money. I'm one of just many people that made life-changing money on Tesla stock, right? And I watched how many people were upset about that, really genuinely mad. Me personally, I just don't even know how do those people even think? Literally, how does your brain even get to that place where you get mad that other people make money? If somebody tells me they made a bunch of money on a stock, awesome, I'm rooting for you, great, that's awesome, man. I'd rather you have way more money than less money, right? If you have way more money, there's a higher probability you can buy products and services from me. There's a higher probability you're going to be able to spend money with my companies, right? Okay, you make a bunch of money on a stock. Why would I hate you for that? Good, I'm happy. You might go to North Italia tonight and spend at Cheesecake Factory, one of my companies I own, right? You might buy a new pair of Nikes. You might buy a new Tesla, one of my stocks, right? You might buy some stuff, get some ads fed to you on Facebook and Instagram, and then go buy some stuff off there. I make money off that, right? You might buy, a year-long membership at 1000xstocks.com. I want you to win. Like, that's the best thing for me. I can never get in this mindset these other people are in that they hate it. They hate it when people make money. What are you doing? You want to be broke? Like root against everybody. Okay, be broke. Like, I'm rooting for everybody to make money. I want people to make money, right? When I had my real estate marketing company back in the day, this is like 2016, 2017, I wanted all my realtors, all my brokers, I wanted them to make as much money as possible, sell as many homes as you possibly can, because that means they're going to probably book me for more photo jobs. That's going to mean they're going to want more community videos and drone videos of homes and all the different stuff I was doing back then. Like, bravo. But in regards to Palantir, you got to understand a lot of people want this stock to crash because they don't like people making this much money. And I shouldn't say it's a lot of people. I would say it's maybe 5% of people. But those people are really rooting against the stock. They want us all to lose money. They would love the stock to be $5 a share, $3 a share. They would love it to be bankrupt. Nothing they would love more than Palantir to be a bankrupt company. Nothing. I could never get in that mindset. That's a mindset of a hater and a very flawed individual. Could never get into that. Like, you make money, great. I would love everybody to make 1,000% gains on stocks. That just means you're going to spend a whole bunch more money in the economy, which is going to benefit so many of my companies, right? I want all the companies that use Palantir's products to have the most success possible. Because those companies, if they make a bunch of money and Palantir saves them a bunch of money on their business model, they're going to spend more and more with Palantir over the coming years and sign even bigger contracts. So, understand that that's where a lot of the crash crowd comes from. It comes from really two sides. People not understanding how to value companies, right? And valuing a growth company is very difficult, especially for newer investors to the market, right? And additionally, just people that they don't want to see that. That hurts their feelings. So let's run some numbers here on Palantir with 30% plus revenue growth and get ready to have your flapjacks flipped here, folks, okay? So the first one I ran is just a baseline 30% revenue growth on average over the coming years, right? 30%, 25, 26, 27, 28, right? I ran net income growth at 40% clip, so a little outstripping the revenue growth, which shouldn't come as a surprise. The company's very early stage in regards to their whole profitability cycle, so I think that's very probable. Net income margins, believe it or not, here are not even 30%, 29%, which come 2028, I think Palantir's net income margin should be way over 30%, in my personal opinion. But in this scenario, I just want to show you guys how powerful this is. You're talking about a 29 net income margin, 29%. P ratio, what are you going to command? If you're growing top line 30%, bottom line 40%, on average per year, you're going to be able to command a P somewhere in the 75 to 95 range. Easily, by the way. So in this sort of situation, Palantir's stock price would be somewhere around $78 to $99, which gives you a compounding annual growth rate. Even buying the stock today gives you a compounding annual growth rate of 18% on the low end and 20% on the high end. That's insane. And that's buying the stock today. Not talking about getting it back for $6, $7, $8, $9, like it was a couple years ago. That's buying it today. Still gives you those compounding annual growth rates. Now you might say, 75, 95 PE, isn't that high? No, we already discussed that earlier. No, when you're growing at these sorts of growth rates that are massively outstripping the market, you're going to command a way higher PE ratios in the market in general, right? And so between Palantir's sticky business model, right, and being the holy grail business model, like a 20p doesn't make sense. Like, you're going to command at least 4x to 5x where the market's trading at in general, right? So that's pretty insane. But let's take it up a notch. Let's say they get to around a 35% revenue growth rate with a 50% net income growth rate on average, right? Which I don't think this is a crazy numbers to imagine. I think this is also possible. If you run 35% revenue growth on average, right, and net income growth of 50% on average, that puts you in net income margins of 33% come 2028. Not a crazy number. It's a very impressive number, but it's not crazy. There's business models out there that are high 30s, that are mid 30s, and even Apple, which is still a very hardware intensive business. Look at their net income margins. They're unbelievable. And that's even a hardware business, right? Keep in mind the software business side of Apple, the services, is much smaller, right? So if you're growing 35% top line on average, 50% bottom line for a SaaS-like type company, you're going to command a P somewhere between 95 and about 115. That puts the stock price at 131 to 158 come 2028, which gives you a compound annual growth rate from here, buying the stock today at $40, of 34% to 41%. Now you begin to understand why the revenue growth is so key. And whether we grow at 20% revenues or 25% or 30% or 35%, I'm telling you, it fundamentally changed the way you have to value this company in a substantial way. Now, let's say Palantir gets to 40% revenue growth, right? 40% on average for the next 4 years, and net income growth of 55%, right? That would put the net income margins in this scenario at actually 32%. Not crazy. Like I said, I'm expecting 30% plus net income margins come 2028. You would be able to command a 95 to 115 PE easily here if you're growing 40% plus a year top line and 55% plus or 55% a year on bottom line. Any day of the week, 95 to 115 here, right? That puts you at a compounding annual growth rate of 39% on the low end and a compounding annual growth rate on the high end of 46%. And that's buying the stock today at $40 a share. Incredible. Now, also, additionally, keep this in mind. There's going to be if Palantir turns into an ATM over this next 4 years, which I can say there's a pretty high probability it turns into an ATM. What do I mean by an ATM? I mean, Palantir is going to be a profit machine. They're going to be spitting out ridiculous sums of net income over this coming years, in my opinion. We're at the early stage of net income, like early stages. This company is going to start producing billions of dollars of net income a year. So what they're going to be able to do is they're going to be able to buy back a massive amount of shares. Now, keep in mind, they're always going to dilute some shareholder value due to essentially, let's call it giving vesting shares for employees and stuff like that, executives. But if you're just producing ridiculous cash flows and net income, you're going to end up being able to be in a situation where they could buy back way more shares than whatever they're diluting in the shareholder base. So that could honestly make the earnings per share even bit bigger, right? Because let's say they get to, this number here, $3.4 billion of net income come 2028. Well, if they're buying back billions of dollars of stock each year as well, right? Which they could easily do if they want, because if you're producing that sort of net income, like easily they could buy back billions a year, right? Well, then your earnings per share is going to probably be even way higher than this number here, which once again is going to make your company look even better, which at the end of the day is going to make you even have a higher valuation. So that's something to kind of keep in mind in regards to that. So my opinion in regards to where the stock price goes, if we have revenue go 30% plus, right? And if we have CARP commit to thinking the company's going to start growing 30% plus again on average, the stock going 50 plus quick. If revenue was to go 40% plus, all hell breaks loose on Palantir. All hell breaks loose. We'll go $75 plus on the stock quick. And you think people have gone crazy in regards to Palantir so far? All I can tell you is if we got a 40% number in the next couple quarters, you ain't seen nothing yet. Everybody would be talking about Palantir. When I say everybody would be talking about Palantir if we got 40% plus revenue growth, I'm talking everybody. I'm not just talking, it's a niche stock in the retail community, or it's a big stock in the retail community, or it's popular on X, or it's popular on YouTube, or whatever. I'm talking CNBC. I'm talking Bloomberg. I'm talking it would be a major subject of conversation on a day in, day out basis. Every day on CNBC, people would be discussing Palantir stock. Every day on Bloomberg, it would be covered everywhere. Because at that point in time, Palantir would be way over $100 billion market cap, which then it starts to matter to the big guys, right? The stock price would be in such a hot spell that everybody would be talking about Palantir, right? Which honestly, the more people that talk about Palantir, especially on all these business news stations and whatnot, right? CNBC, Bloomberg, remember who Palantir's core customer base is. It is a lot of those big companies, which it actually helps the sales cycle for Palantir as well, which is beautiful. It's not just it is attracting way more investor attention. It's attracting way more executive attention. It's attracting way more business attention, which then attracts even better employees, even better executives, right? Even, when I say executives, I don't mean the top guys. I mean let's call it the number 10s, the number 20s at the company, number 30s at a company, right? It attracts more engineers. It attracts more people that are interested in your product and service. What's this Palantir got going on? Oh, wow, their product looks game-changing. They see all these other executives and CEOs speaking about the product. And remember, in my opinion, Palantir has a flywheel effect just starting at this point in time that's going to really compound over the next few years. And that's this flywheel effect of executives using Palantir's product, having success with it, then going to other companies, bringing in Palantir, talking to other executives, telling them how amazing Palantir is. And it creates this beautiful flywheel effect where Palantir doesn't have to worry as much about selling the product. The customers are going to do the selling of the product, which is the holy grail of this sort of business model, right? Which is absolutely incredible. So that's the moral of the story here. Revenue goes 30% plus. We're going 50 plus in the stock price. Revenue goes 40% plus, which would be just knock everybody's doors off. We're going 75 plus in the stock. And the amount of hype and attention would start to come to Palantir would be ridiculous. So in regards to me personally, $22,255. Oh my gosh, I love this. Look at all those twos and look at those fives, guys. Oh, you know how. 5. You know I love that. You know I love that. Oh my gosh. Anyways, I'm holding the stock. And let's see, right? It's a freak stock. There aren't many companies that could all of a sudden just surprise the upside in regards to their growth rates. Palantir is one of very few freak companies out there. And so at the end of the day, I've made a lot of money on this stock. And I got to continue to hold every share I have in the stock. Can't sell it because it's just too much of a potential upside here to even make it make sense to say, I'm going to cash out of this one. Hey, it's Jeremy. I hope you really enjoyed that clip here today. Would you like the ability to understand how to do your own research and not just rely on others to tell you which stock to buy? Would you like to have confidence in yourself when it comes to making your own investment decisions out there? If you're going to be able to do that, you got to have full understanding of everything you need to look for in stocks, how you can decipher whether a stock is a buy, not a buy, all those sorts of things. That's where my private group comes in to help. The description area down there will have a link to apply to join my private group. We've taken over 1,000 people over time and been able to teach those folks exactly what to look for in companies, how to research companies, how to understand financial statements, understand all the different metrics so you can make judgments on companies. And we've been able to have so many people, an incredible amount of people, hit 6 figures plus in their portfolios, 7 figures plus, even some hitting 8 figures plus in their portfolios over time. So if you're looking to take your game up to the next level and play this on a much higher level, apply for my private group. Once again, the link is in the description area. Next one up here is NVIDIA's game to lose in the semiconductor competition.
More broadly, top chip analyst, Bernstein, Stacy Rascon. Welcome back. It's nice to see you. So I know it's too soon for you to talk about this company specifically, but at least it raises the issue of companies that are out there that want a piece of this AI pie. How should we be thinking about these newcomers relative to the heavyweights like NVIDIA?
Yeah. So there's a number of areas of competition for NVIDIA, which makes sense. It's an enormous potential opportunity, and all the dollars right now are flowing to NVIDIA. And you've got other merchant suppliers like AMD or even Intel. You have hyperscalers doing their own products, and then you have startups as well, right? And I think for a lot of the startups, it's difficult. They don't have scale.
Yes.
They don't have ecosystem, and if their pitch is, we have a chip that's better than NVIDIA, I think that's hard because. With every generation, NVIDIA has a chip that's better than NVIDIA, and they have the software and all the ecosystem support that goes with it. So I'm not going to comment on Cerebras, but they're doing some other things. I mean, clearly, they're gonna try their best at this point. But in general, so far it's been a winner take all. And I've said this before, it seems like it's NVIDIA's game to lose, like more broadly.
Well, I mean, it's winner take most, right? I mean, it's not like Broadcom hasn't done well. No. The issue, though, is that, as it's done better, its multiple's gone up, hasn't it? So it's not as cheap as it was viewed to be before.
That's true. And so to be honest, if you're talking about the real competition, I actually think it is more on that hyperscaler side, the cloud vendors doing their own chips. And this is an area clearly where Broadcom really shines. They're doing a lot of the ASIC work for the key players like Google and Meta and some others. And it's a very big business for Broadcom. They said $12 billion in total AI revenues this year. I bet $8 billion of that 12 is probably custom AI accelerators and ASICs for those large guys. And look, I actually do think that is real, and it will get bigger. And I wouldn't be surprised if the penetration of ASICs relative to the broader TAM gets bigger and bigger over time. It's kind of apples and oranges in some sense. It's more, those stuff is more used for the internal workloads of the hyperscalers versus workloads where you need programmability or anything that's customer facing or enterprise. So they are kind of two different markets. But yeah, I mean, this is a market that's already sizable and it's getting bigger. But to be fair, I think the overall opportunity, the TAM is big enough for both of them to benefit. I don't think it's a matter of one necessarily winning over the other. The market's sizable enough where I think both of them can win. And I like NVIDIA and I like Broadcom. We like both stocks.
I mean, but that kind of squeezes out AMD, doesn't it?
Well, I mean, this is one of AMD's like broader issues. I mean, in the near term, and by the way, they have an AI event coming up in a week or two, and we'll get some new product announcements, and we'll see. And they suggested they'll do $4.5 billion or more than $4.5 billion this year. I think expectations are probably for 5+, and I don't want to knock them too badly, because it was zero a year ago. I've said this before. So on an absolute basis, ramping up, $5 billion of a product from zero in a year is nothing to sneeze at.
True.
In the grand scheme of the dollars that are getting spent, though, it's not very big. NVIDIA will do well over $100 billion in revenue this year. Again, Broadcom's going to do double digits in total AI revenues. So it's not that big, but it's good. But long term, I mean, you bring up a good point. Like, I understand the need for a second source, but most of AMD's exposure right now is at these larger hyperscalers. And is that second source, does it need to be the AMD or is it Broadcom? I think that's an open question at this point, yeah?
Two quick ones before I let you run. What's the outcome, the end game, whatever you want to call it, for Intel? What happens here?
Yeah, I mean, that's a great question. I mean, they've kind of bet the company now that their 18A, their next generation process that they call 18A, they're betting the company on its success, and so that's I guess what we're waiting for. And if it is truly successful, maybe you could see a revitalization. They bring a bunch of, they're outsourcing a lot of stuff to TSMC right now. It's killing their margins. You bring the stuff back in, the margins get better. Ideally, it's a better process so they can take back market share and they can charge more because they're better products, and it gives customers a lot of confidence to put a lot of foundry volume there. And that's how you kind of build to the targets that they put out there for 2030. And keep in mind, it's only 2024 right now. There is a lot of wood to chop, though, between now and then. And if that process does not knock it out of the park, if it's not successful, then, there are some more severe scenarios that may come to play. And to be clear, I don't think they're desperate at this point. We've made this point before. I think given the OPEX cuts and the CAPEX cuts and the dividend suspension and the government funds and the private equity funds that they've gotten, I think their cash position is okay. So I don't think they're desperate. They don't need to make any crazy moves, but they probably got a year, 18 months, to see if 18A really holds muster or not. And if not, then there are more severe scenarios that may come to mind.
Oof. Brutal. Yeah, it's we'll see.